for right now, we've gone through all the information you need for your investment plan. So we've done everything. So now what I'd like you to do is I'd like you to open up your investment plan template on your computer. I'd like you to open up Exhibit 1, which is Tool 18, and Exhibit 2, which is Tool 20. Because we're gonna put all of those things in our investment plan. We're gonna go through it one piece at a time. Okay. First thing, make sure your information there. Once you have something you've corrected, then you can release the yellow.
Take off the yellow.
Take off the yellow. So generally we put yellow there to help you know what are the things you need to put. So once you put your name there, financial plan, section, and date, you can remove the color.
But you can also take out that box.
Yeah. Anytime you see boxes here, these can go out too.
The instruction box.
Okay, first of all, investing opportunities in my country. If you're from the U.S., you've got pretty few. You can kind of put, what about if you're from the Philippines or Fiji or something like that? I would just go to AI and say, as a Fijian student, what are some of my long-term investment opportunities available? And there may not be a lot.
So you're going to put that in here.
Right.
Right there. Things that are available in your country.
Okay. And the most important thing is safety. A lot of times you can put your money in, but it's really hard to get money out. We want to make sure that you can get your money out of it. Okay, let's start with our introduction and purpose. Again, this is your framework for your investment plan. An investment plan is also called an investment policy statement. And so what you do, you put your name and your spouse in there. And then remove the...
And then remove the yellow.
Remove the yellow. Okay. So purpose, and things that are not in yellow, this is kind of our recommended wording. You can actually change it, but it's kind of our what we would recommend. Just go no code.
Just deleted it.
Control Z.
Sorry.
Okay, just come through to this one right here. There. So the purpose, detail how the plan's assets are determined, invested, managed, and evaluated. What we're doing here. Principles, again, we use those principles up top. You're welcome to add more principles. If you want to emphasize one, that's okay too. But generally, if they're in black, we think that's a good framework. So do you want to continue? So what's our objectives? Share their investment vision, set goals, develop plans, and strategies to accomplish the vision and goals. And then constraints and accountability. Does this sound like very consistent with what we've done in the past? Yes. Okay.
So you can just leave that. You don't have to do anything unless you want to.
Yeah, you can change it if you'd like, but that's kind of our recommended wording. Investment vehicles. So the team will use multiple investment vehicles, sub-accounts. So remember we talked about taxable accounts, which are tax now accounts. We've got tax deferred accounts, which are 401k, and then we talked about tax eliminated accounts, which are retirement.
So like if you're from another country, you can talk about what retirement things are available in your country, if any, and then also education accounts that might be available in your country.
Okay. Now then we go to time frames. Remember on Exhibit 1, you set your age. Come over here. 18.
This one?
Yep, coming down a little farther. Remember you set your age at retirement here? Okay, this person said they were going to retire at 65.
Right.
Right there, so we're going to go back here.
So they wrote here, right here. Oops.
So we're going to put 65. So again.
Just make it white. Oh, 56. Okay.
Okay. And then expected return. Remember we talked about that?
So remember, accumulation stage is when you're having an income, and then retirement is when you don't have any more income.
Right. Okay. Remember too, we also talked about our expected returns. This is right here. And this person here had an expected return of 7%.
So it's on your T18. It's on your It's on your risk
Exhibit
tolerance
1.
test. Yeah, Exhibit 1 at the bottom. And so you have to look and see what your number is and change it to whatever your number was.
And again, think about what do you think is a good number. We recommend somewhere between 6 and 7 for long term, and then probably 5 to 6 for.
But whatever's on your form, that's what you're going to.
Yeah, that's what we recommend you use.
On yours. Okay. It's on your Exhibit 1.
Okay, so on ours was a 7%, 7.0%. And then ours was a 6.5. And just use what you use there.
So just change it and then put yellow. Take off the yellow.
Now remember too, this also told you what type of an investor you were. So this person was
aggressive.
An aggressive investor. So now what we've done is we've just finished the section on investment goals and objectives. Our goal was a return of 7% a year or whatever it is.
Where's that?
That's our expected returns. We plan to retire at age 65. We're going to be used numerous times accounts, and we're aggressive investors.
Okay, so we changed that 7 here and the 6.5 here. Okay.
Then we're going to talk about guidelines. So generally, we talked about what are the different goals. Before retirement, most of you, your goal is going to be accumulate assets. And hopefully at retirement, you're going to distribute those assets and use those assets to live on. Maybe in retirement, you'll still work. And that's okay too. But you need to think about how we're going to do this too. What are some constraints? So generally, there's 4 different constraints to think about. Number 1 is liquidity. When are you going to need money? So for U.S. investors, generally it's going to be things like this to purchase a home. Now, it could be education and missions for your children. So we've just given some ideas here. You might want to travel when retired. Lots of different things, but this is where you put in what are your liquidity needs?
What's going to take your money?
What's going to take your money? So Sister Sudwick and I, on ours, it says we want to serve missions when we retire. So that's been on ours. Yes?
Specifically for retirement?
Yeah, it can be both before retirement and after retirement. So
what are your constraints in saving your money? Right?
Yep. And then time horizon. When are you going to need the money? So realize investing isn't just one big pot. You're going to have some pots, and this is going to be my retirement basket. This is going to be my down payment on my home basket. And this is going to be saved for my kids' missions and education baskets. So you're going to have lots of different baskets. So let's talk about some of those baskets. So the time horizon, those baskets will have different time horizon. So your accounting money, retirement money, if you're 25 and you're going to retire at 65, you're going to have a 40-year time horizon. So, but what if you have kids? If you have kids, okay, they're going to need some. If you choose to help, they may need help for college, and they may need help for missions. So assets in the education IR, let's say those have a 15-year time horizon.
So, but you have to put this according to where you live and what you're planning to do for your children.
So yet, your oldest child is 5. So different things, we tried to give you some examples there for different needs. If you're single, you still may think about, you might have, when you do have kids, you might want them to go to college and missions too. Okay, then taxes. Sadly, taxes won't go away. Right now, everyone's in the 10% marginal tax rate. And the state tax rate depends on where you are. So for example, if you're in Hawaii, it's probably a 5% marginal tax rate in Hawaii. Utah is 6.5. but you can kind of put where you want.
So
And
notice
then-
how he's taking all the brackets and the little dashes off, and he takes the yellow off.
And then if you're married, you want to do married, filing, single. If you're joint,
Mailing, filing jointly.
married, filing, jointly.
Or if you're single, write single. Just
If
whatever
married.
your tax
Yeah,
is.
whatever your tax rate is. And then the average tax rate was, what did you pay last year? Most of you paid 9% or something like that. It kind of depends on what it was. If you earn no money, you have a 0 average tax rate if you earn no money.
But most of these kids had
Yeah,
money.
most. Let's say 9%. And if you're not sure, just guess. Don't worry, we're not going to second guess you there too. And then do you have unique needs? I have a good friend. His daughter is 34. She's an autistic child. She's at about a six-year-old level. So when he passes away, he's going to have $1 to $2 million just to take care of his daughter. So if you have special needs, this is the time that you kind of think about those things as well too. Okay, questions? Does that make sense? So what we've done is we've talked about guidelines and constraints. We've talked about when are we going to need money? What are we going to need money for? What's our taxes? What are our unique needs? Okay, then what we want to do, let's go into investment policies, plans, and strategies. One of the biggest mistakes I've seen is people investing in things that they have no expertise in. The other big mistake is investing in unregistered investments. So let's talk about what are the things we think you should be investing in. We call this acceptable asset classes. I think anything that has a positive risk-return trade-off. So most stocks, bonds, things like that. Again, these are just different types of investment: cash, money market, savings bonds. It also includes high-yield savings, things like that. I think stock mutual funds. I think bond mutual funds. I think all of those are good. And then other things, just like real estate investment trusts. I think those are good assets as well. What are the things that we don't think you should invest in? First of all, we don't think you should invest in things that have a zero-sum game. Meaning for you to win, someone else has to lose. Because generally what's on the other side? Hundreds of PhDs a lot smarter than we are with billions in computer systems. We don't recommend derivatives. We don't recommend collectibles. We don't recommend foreign currencies. We don't recommend cryptocurrencies. Someone says, well, why don't you like cryptocurrencies? And I said, as a long-term investment vehicle, it doesn't meet any of the criteria. It pays no dividends. It earns no income. Its only value is determined by what people are willing to pay. It's kind of like your collectibles, too. Kind of like gold. Do I have a problem with you putting 3 to 5% of your portfolio in cryptocurrencies or gold? No, I don't have a problem with that. But I would have a problem if you have 30 and 40 and 50%. And what happens? People get so greedy that they just put everything in whatever the flavor of the month is. And that's not investing, that's speculating. So, debt. How about using debt to invest? What have our leaders said? They said don't do it. So we don't buy on margin. We don't sell short. We don't use leverage in the portfolio. Okay. Then we come to asset allocation and investment benchmark. Let's go back to tool 18.
Which is Exhibit 1.
Which is Exhibit 1. So we're actually just going to come up to this. We're going to come up to this.
It's the asset allocation targets.
So we're just going to come here.
Wait, you're going really fast.
Okay, so I just copied that there, asset allocation targets. And then I can highlight this right here. And guess what? It just copies right over.
You redo that, please.
Okay, so I'm going to come over to my asset allocation targets here.
It's on your T18 form.
T18, that's the one you came up with.
It's Table 2 on your T18, summary allocation. Copy it.
Then I'm going to highlight this right here. Right click. So now what do? I have my asset allocation targets. I get rid of the yellow here. So short term. Yeah, if you just, no, not that one right there. Just click on it. Oh, no color, okay. Okay, then let's go to Control Z. Okay, that's good. Okay, so then just get rid of those yellows there too. Then what we do, let's go to our investment strategy. What is our investment strategy? So again, what do we recommend? Especially when you're starting off, we recommend that you just use a passive strategy. Spend your time doing the things that you're good at, which is your accounting or management or running your business or things right here. So we recommend roughly 90% in a passive strategy. Again, we like low cost and tax efficient index funds. How about buying individual assets, buying individual stocks and bonds?
So he's recommending that you just keep those things there and just take off the yellow.
Yeah.
Just keep it.
We recommend that you don't buy individual assets until your portfolio is like $750,000 or $1 million. The reason being is if you buy an individual stock or bond when you have a small portfolio, you immediately violate the principle of diversification. You violate the principle of low cost because these are some of the most expensive asset classes. So it's automatically not diversified, it's low cost, it's very volatile, things like that. So read through. Sister Sedgwick and I put together a 60-page document to help you through this. Read through it. I think it will help you. So we don't recommend individual assets until you've got almost $1 million. Sister Sedgwick and I don't buy individual assets. We're really boring. We just buy index funds because we got more important thing to do with our time, like hanging out with the kids, like teaching you guys, like serving missions, like playing. New investments, we don't recommend any new investments more than 5% of the total portfolio assets, except for index funds that have more than 150 securities in it. Again, we want to make sure that you're diversified. What happens is people hear, this asset class this investment's doing really well, and they'll put 50 and 60% of their portfolio there. And I had a good friend who had this one deal that couldn't be missed, and so he took 80% of his portfolio and he invested in a UK unregistered firm, and he lost it all. So be wise. So that's what we're trying to do. Is we're trying to help you to be wise. How about once you have a job with a company like Microsoft? Oftentimes they'll give you you can buy shares at a reduced cost. Well, what's the maximum you should have in your company retirement plan of your company stock? So we recommend something like 10%.
You can put whatever you want, but we recommend 10%.
So what happens is there's a company called WorldCom. There were some people there that put 80% of their retirement money in their WorldCom stock. When the company went bankrupt, guess what happened to the value of their retirement? So the principle is diversification. So if you're already working for the company, try to diversify your assets.
Or if they give it to you for free.
So if you get some free shares, or you can buy it at a reduced price, if it's not a long time before it's vested, meaning it's yours, a lot of times what people will do is they'll get those free shares and then they'll use them to pay their tithes and offerings the next year. So that way you can keep it. Okay. Current assets and investment strategy. Again, your paper portfolio is your current investment strategy. Tax strategy. Again, our goal is to minimize taxes at a given level of return. Funding strategy. Hopefully you'll take seriously the goal to save. Hopefully once you get out of school, you'll probably save more money for your down payment on your house. And once you have that house, then I hope you get serious on the retirement side. What percent of the people do you think out there that actually have an investment plan written?
All the people that took your class.
People that take my class. But what does it do? It gives you structure. It gives you a framework. It eliminates a lot of the problems that lots of other people have. People chasing returns. People investing based on what their neighbor said. People investing based on what the flavor of the month is. Will the flavor of the month change? Yeah. Cryptocurrency is the big deal, this one. It might be gold, it might be platinum, it might be rare metals. I don't know what the flavor of the month is going to be next month, but I know there is one. And so what do we do is, again, if you do what everyone else does, you'll get what everyone else gets. And realize that most people get poor performance. Most people underperform their benchmarks 2/3 of actively managed funds outperform or underperform their benchmarks. And that's according to SPIVA. So we need to be wise in what we do. Again, if we follow the principles, we'll do a lot better.
So our takeaways are speculative practices may work for a time, but economic reversal always seems to come and financial ruin follows. And don't borrow yourself rich. It doesn't work.
Okay. Thanks, everyone.